Good morning and welcome to this Wednesday, August 5th, 2020 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, I tell you, the market just doesn't want to give up. Had a ADP employment report out this morning and came in way below expectations. Market expecting 1.8 million new jobs, came in, I think, 167,000. I got it written down here somewhere. Yeah, 167,000. The estimate was almost 1.9 million. And yet futures still clinging to green numbers. So again, I think it's more the market continues to look ahead. And while, yeah, it was disappointing news, we still have the non-farm payrolls, by the way, coming out on Friday, and that's more closely watched. But still, this was a head scratcher. I mean, it was a big miss, and yet the market just seems to be ignoring it, which is kind of typical in a bull market. We've seen the fear coming down, and I think overall, I think the action. It's hard to really label it as anything except extremely bullish. Currently, we do have Dow futures still up 196 points, S&P 16, but the NASDAQ, which was up, I don't know, 40 or 50, is now up only 5. So very muted positive reaction there in futures on the NASDAQ. We'll see what happens when we actually close, or excuse me, when we open in about 30 minutes. But for now, I mean, I think the market actually has handled the disappointment pretty well. And we're going to get into all that in just a minute. I do want to point everyone over to the EarningsBeats website. Just make sure, if you have not already, please subscribe to our free EarningsBeats Digest newsletter. It's no cost, free, no credit card. You can unsubscribe at any time. No feelings hurt. This is one way we give back to our community, and love to just pass along some of our knowledge. I mean, that's the whole thing. It's very educational. Talk a lot about earnings impact, how it impacts technical analysis and how we view earnings, how we trade off of earnings. We look at relative strength, take a look at individual industry groups from time to time, the overall market we might address once in a while, but definitely a very educational type of newsletter. So we'd love to have you join. But there's even a bigger reason. We have a free event coming up on Monday, and that is our sneak preview of our top 10 stocks webinar and event that we're going to have. The actual event, which is for only paid members of EarningsBeats, is on August 19th. So that is, can't believe it's 2 weeks from today. Hard to believe that another quarter is behind us. But that event will actually be the release of our 10 stocks in each of our portfolios. And if you look over here on the right-hand side, you can see our portfolios, for the most part, have been crushing the S&P 500. So the whole idea there is we put 10 stocks, leading stocks in leading industry groups, into our portfolios, and they sit there for 90 days. No stops, no profit taking, nothing. It's kind of it's a hybrid. It's a little different. It's not buy and hold, because we're not buying and holding for 10 years. We're buying and holding for 90 days, 3 months. But you're constantly putting your money to work in companies that are leading. And at the end of 90 days, whether things work out, don't work out, we're going to change them. And we're going to go with what we believe are the 10 leading stocks, again, in leading industries. And so I think our track record speaks for itself, but that event is going to be 2 weeks from today, Wednesday, August 19th. It'll be at 5 o'clock Eastern. Coming up on Monday is a free event. It's open to everyone, but we're going to be sending out room instructions to our free community. That includes those who have subscribed for EarningsBeats Digest. That's why we want to make sure you sign up. I think you're going to enjoy the newsletter to begin with, but that's where we'll be sending out our instructions so that you can join our event on Monday, August 10th, which is only 5 days away. And that webinar is going to talk a lot about our strategy and our process and the things that we look for in order to create these different portfolios that have been outperforming. I think most portfolio managers Anyone, if you've got a hedge fund or whatever, the whole idea is to try to beat the S&P 500 by 1 percentage point. If you can tout that you're beating the S&P 500, you've got a leg up on most everyone else. If you look at that model portfolio since inception, I mean, we're getting close to 2 years now. November, it'll be 2 years. We've got 123% total gain in our model portfolio in 21 months. It'll be 21 months in another 2 weeks versus the S&P 500's advance of 22%. That's more than 100 percentage points higher. I don't need to tell you what that can do to a portfolio. And I'm not here to tell you that we're going to do that for the next 2 years. I mean, it's very difficult to outperform the S&P 500, but I think our strategy is a sound one. Sticking with leaders, leading stocks, leading industry groups. There's a reason that they're leading. You're focusing, you're concentrating your money in on those leaders. So I think coming in and joining us on Monday, I think would be great. So just sign up. Trust me, it'll be worth it. I think you'll really enjoy the event coming up on Monday. And in the meantime, you'll continue to benefit from the 3 times a week newsletter and the things that we provide there. All right, let's go on to the market and what happened yesterday. Just want to pull up first the Dow Jones Industrial Average up 164 points. The S&P 500 up 12, NASDAQ up 38. I mean, if I sound like a broken record, I pretty much am. Market continues to go higher. Mid caps up 0.5%, almost 10 points. The small cap index, S&P 600 small cap, up about 0.5%, up 5 points. So on a relative basis, there really weren't any major leaders. We saw a little bit of lagging in the S&P and the NASDAQ, a little bit of leadership maybe from the Dow, but for the most part, it was just a concerted push to the upside across all of our major indices. Now, when we look at the sectors, and I always like to look at sectors to kind of get a feel for what's going on. One day doesn't make a trend. But when I look at the leaders across here, this is not exactly what I want to see. Energy, real estate, materials, staples, utilities. Where's technology? Where's consumer discretionary? Where's communication services? Where are the financials? Where's industrials? Where's all the good stuff? Well, it wasn't there yesterday. But again, one day doesn't make a trend. One thing that I absolutely am watching very closely are definitely the energy and materials. And the reason that it's important to watch that is the dollar has been weak. We saw what looked like maybe a big reversal latter part of last week, or maybe it was Monday. I'm not sure which day. I think it was last Friday. But we started to reverse off of a low in the dollar. And if the dollar starts bouncing, I would expect energy and materials to struggle on a relative basis. I would not expect them to be on this page where we highlight sector leaders, but the dollar reversed and went back down. And if the dollar struggles and if the dollar continues and moves back to a new low, then yes, I think that energy materials could be big winners as we go forward. We do have the dollar down about 0.5%, at least based on the Dollar Index Bullish Fund, the UUP. This morning it is down about 0.5%. So that should lead to, at least initially, some more strength in energy and materials on a relative basis. And I think that's why, one of the reasons why we're seeing futures the way we are this morning, with the Dow leading a little bit more than, say, the S&P or the NASDAQ. Same goes with the action yesterday, Dow leading the NASDAQ. You start talking materials and energy and some of the areas outside of technology, then we may see some relative strength in some of the other areas. And by the way, just because of the NASDAQ and technology take a back seat for a while, that's not a bad thing. What would be a bad thing is if they broke down. The fact that they're not showing leadership for a period of time, that's just rotation. Rotation in a secular bull market, it's not only okay, it's good. We want to see everything participating in the move to the upside. And to be honest, we haven't really seen that. I mean, a lot of stocks, a lot of groups, you can see energy. Yeah, we're way off the low where we were back in March, but we're sitting about where we were 3 months ago. You can see the Dow's been moving up, the S&P's been moving up, the NASDAQ's been rocking, and yet energy is not participating in the advance. So seeing money rotating into energy right now would not be a bad thing at all. I'd like to see energy get back up above its moving averages. Materials, on the other hand, look much stronger on a relative basis. And this has been one of the strongest groups It's pulled back this last week or so, but if the dollar breaks down again, I think materials definitely could make another run. I haven't been a big fan of materials, I'll be honest, because I'm looking big picture. I'm looking at the relative strength over the big picture. And yes, the dollar's been weak, but you know what? The dollar was weak back in, I don't know, 2016, 17, I forget which year it was, when we saw materials outperform for a period of time. And then as soon as the dollar bounced, materials fell back apart again. So I don't want to be just jumping into materials for longer term trades when I'm not comfortable that the dollar has broken down. So anyway, I could go on and on about that for a while, but you can see what led the action on Tuesday. Not great leadership, but again, okay. It's okay to do this for a while. All right, let's move on. I want to look at the 10-year Treasury yield. Of course, with that news on the jobs being down, you would think the reaction would be that the bond market would be bought, yields would drop. But early on, we actually see the yields up. Now, some of this could just be a little bit of profit taking in the bond market because the bonds had a big day yesterday. The bonds have been really heavy. That's what's really strong. That's what's been pushing the 10-year Treasury yield down. I mean, since that June 8th, June 7th, or excuse me, June 5th, June 8th, Friday and Monday there, since that high, look at what the 10-year Treasury yield's been doing. And down here on the bottom, I've got financials relative to the S&P 500. If you're wondering why your Bank of America stock's not doing well, or JP Morgan or Goldman Sachs, or, just, you don't need to look beyond this chart right here. When you've got the yield continuing to fall, financials, money is going to rotate away from financials. Does that mean every financial is going down? No. But what it does mean is it's going to be really hard to find winners in a group that is seeing money rotate out of that group. Much easier to find winners in technology. Just throw a dart. You might not have the leader, but most technology stocks are going higher. Most financial stocks, if they're not going lower, they're at least struggling on a relative basis to keep up with the S&P 500. And that's what this chart tells us. As long as we remain in this downtrend, I would be careful owning financials for any extended period of time until we see the 10-year Treasury yield above the 20, which eventually climbs above the 50, and we have that configuration with the PPO turning positive. We saw that very briefly back at the beginning of June. And this is why, again, I'm not a big fan of materials, because you can have a longer term downtrend turn positive for a brief period of time before that longer term trend turns lower again. So got a lot going on there. All right, let's keep moving. S&P 500. I'm going to bring this up again. I bring it up every once in a while because I don't want anyone to lose focus of this particular chart. When you look at the S&P 500, and there's so many people, especially those not following technical analysis, that see the news, they see the headlines, they see the media, they see all the negativity out there, and they look at the market and they say it's overpriced, this is crazy, this is nuts, I can't get in, there's no way this market can go higher. It's going to go higher. That's my opinion, of course. I can't guarantee you it's going to go higher. But my opinion is not only is it going to go higher, it's going to go a lot higher. Some of the numbers that you might think, oh my gosh, Amazon, how can Amazon go any higher? It was 2,200 a few months ago. Now it's over 3,000. Apple, you could have bought several months ago at 220, and now it's over 400. There's no way. Stocks can't go up any faster. Well, when you look at valuations and you look at companies and how fast their earnings are growing higher, and that's the key. It's not just earnings. Earnings are good. Earnings coming in much better than the market expected. So that's, one of the reasons why the market's rebounded off the lows we saw back in March. Back in March, the market discounted. The market was pricing things as though we were heading into a depression. And guess what? We're not. We didn't head into a depression. We're not going to head into a depression. And the stock market is now saying, okay, we initially got things wrong, but we're now coming back. We now see the light and we're moving back to the upside. We are in a long-term secular bull market. And long-term secular bull markets kind of dust off bad news. Just kind of like flicking something off your shoulder. Yeah, it's a pain for a little bit, but then you just flick it off and it's gone. Look back at the 1950s and 1960s. There was a lot going on back in the late 40s into the early 50s and 60s. We had multiple recessions in the 50s and 60s. Yet the stock market, you wouldn't know it. I mean, we had this huge rise throughout those 2 decades. We did price in. I mean, we had a couple of scares, a couple of times we moved lower, but the overall trend was higher. Secular bear market's different. Secular bear market, you struggle to break the new highs. And in fact, you have wicked sell-offs that last much longer than just 3 months, 6 months. They can last a few years, 2, 3 years before you start to rally again. I mean, it just gets very depressing when you go 12, 14 years without breaking to a new high. That's a secular bear market. That's what we saw in the 70s and into the early 80s. Then we broke out. Remember the crash in 1987? There it is on the chart. I can promise you, I was there. I remember I was investing. It didn't feel like a blip on the radar. It felt like the world was ending during 1987. Black Monday, I mean, I just remember just kind of staring at, I actually was on a vacation. I'd come back and was literally staring at the screen when I got back because we didn't have the internet, didn't have the ability to track things. I was out of the country during this week leading up to the Black Monday. So I got back and Black Monday happened. And I just remember the helplessness and the feeling of despair for a while because of that whole period. And yet, if somebody could have looked at you and said, listen, it's going to be okay. 12 years from now, you're not even going to pay attention to what happened in 1987. You just wait what's coming. You would have looked at him and said, you're crazy. I mean, we're heading for a depression. This is awful. And then look at what happened. Then we went through our 12, 13-year period again, and then back out into this secular bull market. Remember quantitative easing? Oh, this is going to, we're going to have hyperinflation. Market's going to be horrible. The Fed's holding everything up. This ain't going to last. The debt, this, blah, blah, economy. GDP's too slow. Debt's too high. I remember it all. And we pulled back, during some of these periods. Got through, really rough consolidation. We went through the election in 2016, and I'm not somebody that talks politics, but there were a lot of folks didn't like what happened there. Market kept going higher. Trade war. Oh my gosh, this is going to be awful. We got we got tariffs. They got tariffs. This and that. We went down 20% in 3 months, came roaring right back, went to a new high. Now we got the pandemic. Everybody, oh, this is it. This is the end. Market, all of our jobs, everything's gone. Well, guess what? We're roaring back now. The S&P 500 at over 3,300. We're now within 3% of breaking to an all-time high. 10 years from now, we're going to look back at that pandemic and we're going to say, wow, what a great opportunity to get in. Again, my opinion. Believe it, don't believe it, argue with me, debate, that's fine. That's what makes a market. You got buyers, you got sellers. And if there's more buyers and sellers, we go higher. If there are more sellers and buyers, we go lower. We will wait and see what happens. But I believe what's going to happen is that we're going to get beyond this pandemic. The economy was strong before the pandemic. I think we're going to see a tremendous strength coming out of it. And I believe money is going to rotate from the bond market. And when all those billions, trillions of dollars come out of bonds around the globe, that's what's going to fuel this bull market, secular bull market. But again, just my opinion. But I wanted to go through that because I think it's really important to understand the big picture and all the noise that we hear. My gosh, if I had been listening every day and if I had focused on what I was being told in the media, and I don't care what media you listen to, I'm not trying to make this a political argument. I'm talking about just the fact that this proliferation of social media, everybody's an expert in everything. And everybody's copying and pasting and posting. They don't know. They don't check facts. They don't check anything. They just post. And then everybody else jumps on board. I can't even look at this stuff anymore. I'll be honest. I don't like to look at social media. I don't like to follow the news. I like to look at the charts. That's all I like to look at. The rest of it is complete noise. And in my opinion, disagree with me, complete garbage. I know there's some that don't like to hear me talking about the media, but you have to understand what their motives are. Their motives are to get clicks. It's not it's not clickbait if you say the S&P 500 is down. It's clickbait when you say the S&P 500 is collapsing. That's how you get people to click on your news article. And of course, the more people you get in, then you can sell ads. You get more. I mean, it's just the way everything works. So, all right, I'm off of that. I'm done with that rant. Let's keep moving on. I want to go through some earnings. And just a lot of companies. I tell you what, let me get over here first. And I'm going to pull up some earnings that came out last night and this morning, and we'll just see what's going on here so far. Disney expected to lose 43 cents. They posted a profit of 8 cents. Big beat. Stock up 5.6%. Looks like it's going to open between these two highs. I think what you're going to see is a run up to about 127, 128 to test this high. Does it come today? Does it come over the next couple of weeks? I don't know. But I do think we're going to head back up and test because we're in a bull market. I think most everything is going to go higher. It's just some things aren't going to go higher as fast as other things. But Disney, I think, they came out. I think their subscription numbers were pretty good. I didn't really look too much in depth at the report, but I did see their bottom line obviously was much better than expected. Activision, this is a stock in one of our portfolios, came in 97 cents versus 68 cents. Great beat. Stock's been going straight up. Everything's built in. Stock down 2.3% after earnings. We've seen this plenty of times. Watch that 20-day moving average if it pulls back that far. Square, wow, big report, big reaction here. Square came in. They were expecting an 8-cent loss. They came in with a profit of 18 cents. Stock had already broken out. I mean, this is the market telling you. It's telling you that Square is going to beat. I mean, there's no reason for a stock to go higher and to do so. I mean, look at back in early June. Look at the volume coming in. That's institutions. Pulling back, holding moving averages, and then moving higher again. Big beat, big gap up. Square is going to be a good stock for a while. Now, is it going to be a good stock to own, to buy right at the open today? I wouldn't do it. I don't like chasing these gaps. I don't know what's going to happen. A gap, the problem is a lot's been built in. So are the market makers going to be overwhelmed with demand at the open? I mean, because we could gap up at 153 and close at 170. In that case, 153, in my opinion, is going to be major support. Wherever we open, if we finish higher than that open and it's on heavy volume, and if we finish substantially higher with a big hollow candle, the bottom of that candlestick, the open, is where I would be looking for major support down the road. Now, if we open at 153 and start moving lower, then I'm going to be looking at the bottom of gap support, which is going to be down at about that 137, 136, 137 level right here at that close. So it depends on which way we go. I don't have a crystal ball. I can't tell you which way we're going to go. I can tell you by looking at the chart that I would have expected Square to beat, and they did. And they're getting a positive reaction. Some beat and they get a negative reaction. It's really difficult to say how a stock's going to report or how a stock is going to react to a report. Monster's been looking much better. I've said this is one of the best stocks in the soda area. It's not Pepsi, it's not Coke, it's Monster. Monster's been a monster. It's broken out, took out that early June high about 2 weeks ago. Has been trending higher. They came out with a really nice report. 59 cents versus 48. Stock up 5% pre-market. Twilio came out. They beat 9-cent profit versus a 9-cent loss. But in this case, they were, priced for really good numbers. The good numbers came in. Stock's down 2 3/4%. Again, I can't, it's a coin flip sometimes as to how the market's going to react to these numbers. Verisk Analytics, another good report, $1.29 versus $1.18. Stock down fractionally there. Microchip in the semiconductors, $1.56 versus $1.43. Nice beat. Stock's been sideways, going back down to 99. Actually, I would say 95 or 96 up to about this 100 area is pretty good support. So we'll see what Microchip does. But what I would do is if it gaps down, you could maybe consider a partial position at the open. But I'd actually like to see the stock move below 95 and then come back up above 95. And on the way back up, that's when I would be interested in getting in with a stop wherever that intraday low was. So I'd wait for some kind of a reversal. We might see some rough action in the morning and then see what happens after that. AVLR, another software company coming out with its earnings, 4 cents versus 10-cent loss. So 4-cent profit versus a 10-cent loss. Stock's down $5 after or in pre-market, 4%. So we're looking at 132. That's in the middle of this range. I mean, it could go anywhere after the open. I look at 120 as being a good buy point, 145 as being a key resistance, and we're right in the middle at 132. So I don't see a trade. Beyond Meat missed 2-cent loss versus a 1-cent loss estimate. Stock down 10 after hours or pre-market. So it's going to be back down to 131. This is still way below its June high. And it's been drifting lower, putting in lower lows. I don't know. We'll see what happens after the market opens, but I'd be careful if the stock were to close below 120. That would probably be my line in the sand there. Wynn Resorts. This is going to be very interesting because Wynn lost $6.14. The market was expecting $4.89, but stock's up 1%. So has the worst been built into these stocks? I don't know, but you don't want to lose these lows down here around 68. Close below 68, I'd be very careful with Wynn. ENPH. By the way, I think I misreported yesterday in the daily market report when I said renewable energy was up because of 2 companies that had reported. One was ENPH, the other was SolarEdge, SEDG. Only SolarEdge had reported. Enphase had a big move up yesterday, and I knew they were reporting yesterday, and it was my bad. I assumed that they had already reported. I think they were just up in sympathy with SolarEdge. They actually reported yesterday after the bell. And so the stock was down 2% after hours. It was down more than that earlier. At one point, I think it was down to 63. I saw maybe it went even lower than that. But 67, I think we've got a nice big cup off of this uptrend. Pull back to the 20-day, I think would be an awesome entry point. ENPH, very, very aggressive, very, very volatile. I remember getting an email from a member when the stock was on its way down. And of course, we had been, it's in one of our portfolios. So the question was, should we stop, put a stop in on the stock? And I said, no, we don't put stops in on our portfolio stocks. We just hold them and we see where they are after 90 days. Some stocks will just take off. Some stocks will fall. I mean, that's just the way the market works. It's just a modified buy and hold. It's a buy and hold, but it's only buy and hold for 90 days. Now, members can do whatever they want. I mean, I'm not holding anybody's hand down to the buy button or, keeping anybody from selling. If you're uncomfortable with the stock or you're uncomfortable with the whole portfolio, don't buy them. Don't, do what's comfortable for you. But the whole idea of these portfolios, I can tell you Apple's a good trade. I can tell you that AMD is a good trade. I can say, hey, this is a good support level. That's trading. This is, and that's a lot of, our service has been built on, providing good information for traders. This whole portfolio thing was for those people that wanted to take advantage of all the things that we teach, but don't want to sit there and look at the market all day. They're working. Maybe they want to golf and hike and play tennis and go swimming and, I don't know, travel, whatever. They don't want to look at the stock market all day. It's a passion of mine, but I understand it's not a passion of some other people, but they still want their money to work for them. That's what these portfolios really are designed for. If you're going to just, if you want to invest, but you really don't know what to invest in, you want to kind of be with, the market and what's working in the market, then consider the portfolios. I'm not going to promise you or guarantee you they're going higher. I can't. I wish I could. If I knew that they were going to perform like they did this last quarter, I'd have all my money in it. I trade the stocks, but I don't buy and hold. That's just not, I tried it one quarter. And of course, I think I picked one of the worst quarters to do it. And the market was pulling back and I'm just sitting there and I'm like, this isn't my style. And so you've got to decide, are you a trader or are you somebody who just wants to not think about it and just put it to the side? And yeah, I know it's investing. I can lose money. So if it goes down, okay, but I'm going to stick with it. That's the type of person I think that should be considering the portfolios. And that's why we started them. So when you look at this and you say, well, ENPH is down, should we put stops in? That's when you're getting back to my problem, which is, am I a trader or am I buy and hold? Am I more of an investor? I think the portfolios are more investing. I think the things we talk about in the DMR every day, I think that's more trading. The chart list that we have available to all of our members, that's trading. Those are the things. So you've got to kind of distinguish who you are and what you're doing. Anyway, another stock that, and actually market just opened. One stock that we have on one of our portfolios is getting a rough treatment this morning, and that's EverQuote. Actually, it's okay. I still don't see it open yet. It was down $5. There it is. So it's down $5, 10% today with its earnings. Now, if it's got, gap support all the way over here at about 44.5, could it go there? Yeah. I mean, could it break down? Sure. Market can do anything. So, I would just be careful assuming that just because it's on one of our lists that it absolutely has to go higher. And, it's a guarantee. Nothing in the market's a guarantee. But these are stocks that we have been, feeling pretty good about. One thing I'll say about EverQuote, even though it's been pulling back and definitely is in more of a downtrend in the short term, its accumulation distribution remains near a high. So I don't know if that's going to matter or not, but it seems like a lot of these moves, when there's been volume, we come off of the lows, and that's what keeps the AD line pretty high. All right, let me give you a couple more of these companies that I'll give you a couple that, one more that reported last night, Planet Fitness. 32-cent loss. The market was only expecting a 17-cent loss. Stock down 4% today, been in this downtrend. This is the kind of a stock in a pandemic that I just can't get my arms around. Planet Fitness, you've got to go into a gym. Most gyms are closed. I don't even know how they're staying in business. I actually have a gym membership, not the Planet Fitness, but I have a gym membership. And right now they've just suspended payments. I'm not paying anything. Of course, I can't use the gym. And so this is a business kind of like airlines that you just are scratching your head like, they're operating with no customers or very few customers. And that can't be good for business. So anyway, let's keep going. REGN, this is one of our portfolio stocks. And they came out with nice numbers. Regeneron, $7.16 versus $6.23. So a nice beat on the bottom line. Stock was up at the open, still up $3. Been consolidating though. I would really like to see the stock make a breakout with its earnings. So we didn't do it at the open, and we need to get a close back above 658. So if we can close today, get the volume coming in, get a close above 658, that would be very bullish. All right, Humana reported this morning. And Humana so far up a little over 1%, sideways consolidating. It's another one, needs to get above that 410 level. Let's get a definitive breakout there. Moderna, this one's been in the news quite a bit. Stock's actually down 3%. I think their revenues were up fivefold, but market doesn't seem to care. A lot's already been built in. I mean, stock was under $20 back in February. Now it got up to 95. I mean, of course, it's going to be, consolidating. And so I'm not shocked by, the fact that we're consolidating. The uptrend's still in play. Wayfair, huge report. My gosh. Expectations $1.02. You want to know why this stock has been going up so much and why this pre-earnings run just went tearing to the upside? Earnings were expected $1.02, came in at $3.13. That will change your valuations, especially if the market believes that there's a paradigm shift and that people are going to do more online shopping. I can't tell you how many ads I get from Wayfair in my inbox. I actually do shop at Wayfair once in a while, and I'm sure they are killing it. I go on that site, I'm looking a lot, and I'm not even a shopper. So I can imagine somebody who likes to shop, probably I could sit on that site all day probably looking at all the things that they offer, with their shipping and the coupons I get in the mail and blah, blah, blah. Wayfair, definitely very strong. This is a stock of ours in our portfolio. Livongo, LVGO, 11 cents versus 1 cent. This is, I did the pitch back at the beginning of beginning of April over at Stock Charts. It was a new show that they were starting. I'm actually going to do another one coming up here, their next airing, which I'm not sure when it is. I've got to do a recording with them. But I've got to give them 5 more stocks. But I gave them 5 stocks back in early April. One of them was Peloton. One was Regeneron, REGN. Just talked about that one. One was was one DocuSign. I don't remember now which 5 I gave them, but there were 5 really good stocks. Peloton by itself would have carried that portfolio. And then I did a webinar over at EarningsBeats recently. Maybe when I say recently, maybe a month and a half ago, probably somewhere over in here. And I did it with Grayson Rose. And we gave 5 new stocks because Grayson was on that show, The Pitch, with me back in early April. And so Grayson joined me again for a webinar at EarningsBeats, and we gave 5 more stocks. And one of the 5 I gave was Livongo. And this stock, I don't know exactly when I gave it, so I don't remember if it was here in the 70s. Maybe it was already, it started moving higher. I don't remember either way, it's been a great performer since. But they came out 11 cents versus 1 cent, another big beat. And the last one I'll give you is CRL. This is a biotech. Charles River Labs, if you look at the relative strength, this one has been on fire relative to the biotechs, breaking out to a new 52-week high. And the stock came in $1.58 versus $1.27. But it is up 1%, but it could struggle because it's got a lot of already built-in stuff. So if we don't get that breakout today, don't be surprised if we pull back and we go and fall into a little bit of consolidation mode. All right, last thing I want to do here, 3 you must see. I know we're running after. I do that sometimes. I'm on a tight schedule when I do Trading Places Live over at Stock Charts because I'm on their channel, and they don't like it if I do a 36-minute show in a 30-minute spot. But here at EarningsBeats, I usually run a little bit longer. Anyhow, let's take a look first at WMB. This is Williams Company. And Williams Company, look at this move yesterday. And I don't know why it's not showing. Oh, I didn't update it. That's why. Duh. Okay, so there's the move up today. It's up a little bit, 0.5%. The reason I'm bringing this up, if the dollar continues lower, energy and materials should strengthen. I would look at energy and materials just like I do at technology or any of these other sectors that I've been a fan of. Look for the leaders. Look for the leaders. Pipelines. Yeah, pipelines hasn't been strong, but you know what? If energy turns up and pipelines turns back up to the upside, look at what WMB is relative to pipelines. It is a leader. It also just broke out above the June high. Did pipelines break out above the June high? No, not even close. This is one of your leaders. This is one of the stocks that Wall Street is favoring, okay? So again, I'm not saying to rush out and buy energy and materials. If that's your thing, if you really like it, stick with leaders. That's all I'm saying. So find stocks like WMB. Look at pipelines relative to the S&P. You know, we're not far from the March low. We're certainly much closer to the March low than we are to the 52-week high. But maybe we're going to turn around. And if we do, stick with the leaders. Next stock I wanted to mention, BMCH. This is in home improvements. And that candle yesterday is ugly. Now, if we go up above the top of the candle, then it negates it. But off of this recent move to the upside and with the earnings coming out yesterday, this was the reaction. Yesterday was the reaction to earnings. We had a breakout, 52-week high. We pulled back. Now, we have got a very strong home improvement group relative to the S&P home improvement strong. BMCH now has just broken to about a 6 month high versus home improvement. So you got a leader. The problem is you also have resistance. I would not be in the stock. In fact, after that candle yesterday, I would have expected lower prices, and we may still see them before the day's out. Who knows? But if this stock were to get back down into, say, 27, 28 area, I think BMCH would really start to look interesting. And then the last one I have, and I just wrote about this today in my blog here at Stock Charts, EFX. I think this is a stock that could go a lot higher from here. Stock is up 1% today. What I would really like to see is a tail that goes below these lows, and then we reverse back to the upside. I actually wrote about AMD. Back this day, I wrote to our members at EarningsBeats. It was in our daily market report. And I said, hey, we had broken down below these prior 2 lows, and we were starting to rally back. And I said, this could be a bottom in AMD. And sure enough, we printed that bottom, and look at what we have done since. The stock is up 70% in 5 weeks. So when I look back now at a stock like EFX, and by the way, when we're looking at AMD, it was one of the leaders in semiconductors. When it first, got to this high, it was at a new 52-week high versus semiconductors. But we consolidated. During this period of consolidation, semis kept going higher. AMD took a pause. When AMD paused, its relative strength went down. But once it set that bottom and started moving up, look at relative strength. Turn right back up, and now it is another 52-week high. Now let's go back to the EFX example. EFX, there's your false breakout. At that high, actually at this first high, look at EFX versus business support services, 52-week high. As it consolidates, it moves lower. Why? Because the group's going up. It's still in a good group, but that particular stock, we were seeing rotation. Now we're back down near support. I would not be surprised, and again, I don't have a crystal ball. I can't provide any guarantees. What I can simply say is that the reward to risk now is much better. When you buy it at resistance, you run the risk of a stock pulling back to support. When you buy it at support, you could break down, but if it breaks down, I'm going to get out with a much smaller loss than if I bought at 180 and then it breaks down. Now it's a much better reward to risk. And so if you haven't already seen my article, I'll just point you there. We'll wrap up the show. Here is the article I just wrote this morning, so go check it out. And please sign up for our newsletter. Get the information. I want you to come in for this Monday event. It'll be an eye-opener for sure. If I haven't already opened your eyes, either if you're a member or maybe you're thinking about being a member, but you followed me over in my blogs, hopefully your eyes are already open. But Monday will be another major eye-opener. And we'll be sending out room instructions to anybody that's on our EarningsBeats Digest newsletter, our entire community, members and non-members, but our entire community. So if you're not already a free subscriber, do it. And if you want, you could join. It's a 30-day, $7 trial, but the $7 will be refunded to you. So for 30 days, it's free. You'll be obviously coming to the free event on Monday, but you also, that gets you into our next stock selection webinar, which will be on August 19th. So for all of our portfolios. So this is a great time to join, see some of the things that you can take advantage of, and check out the annual membership because it is much cheaper. We said we do this for a reason. We think we're worth every bit of $97 a month, but for those that want to commit, you can see we give you a really good deal. Probably 4 or 5 months free out of 12 in order to, if you commit for the annual. So anyhow, that is it. Let's get a quick update on the market, just see what we're doing here. Dow up 230, S&P 16, NASDAQ only 15. So relative basis, we're seeing the Dow. We're also seeing small caps and mid caps doing well today. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV for the next episode of Trading Places Live. Take care, everybody. Happy trading.